Number 3. Supply and demand. Now, what are the supply and demand zones on the chart? A demand zone is an area where buyers previously entered the market and pushed price higher. Similarly, a supply zone is an area where sellers have entered the market and pushed price lower. These zones are important because markets often remember where strong buying or selling occurred. When price returns to a supply zone, sellers may step in again, potentially causing price to move lower. When price revisits a demand zone, buyers may become active again, which can push the price higher. In simple terms, demand zones act like potential support, and supply zones act like potential resistance. They help us identify areas on the chart where price is more likely to react rather than move randomly. But the key point here is that we want to look for aggressive buying and selling when identifying supply and demand, not slow, sideways movement. Strong zones are usually created by impulsive price moves, showing clear imbalance between buyers and sellers. To make things more objective, we need to see 3 green momentum candles to mark an area as a demand zone. Similarly, 3 consecutive red candles with large bodies and strong push distance would make a good supply zone. The reason is that we want to identify an area where traders previously showed interest, rather than just small moves in the market. Now, how do we correctly mark the supply and demand zone range on the chart? While traders use different methods to mark these zones, the most important rule is to focus on the area where the move began. Marking the start of the move largely depends on the candle's formation. So, let's look at some common ways to mark these zones on the chart. Here, this is our latest impulsive move to the upside. This green candle represents the area that created this move, so we mark it as the demand zone because we believe the decisions were made during this candle. When price returns to this area, we expect a rejection somewhere inside the zone. Another common way is to mark the last red candle before the bullish move. This candle represents the last selling pressure in the market. We mark this area as a demand zone because once price breaks above supply, it turns into demand. When price returns to this area, we expect a reaction, which may lead to a rejection or continuation to the upside. Here, the demand zone is drawn from the wick of the candle, since it shows where price was rejected and the momentum move began. The move did not start from the first green candle, nor the previous red candle. It started at the bottom of the wick, which forms our demand zone. Wicks are important price action signals on the chart because they highlight areas where strong price rejection occurred. By marking these levels, we can often expect price to react again when it revisits the zone. With all that being said, here's a very important point. No matter how accurately you draw the supply and demand zone, getting rejected exactly from that zone is not guaranteed. Sometimes the market reverses before reaching the demand area, and other times it needs a deeper retracement. Number 4. Order blocks. Order blocks are a type of supply and demand zone, but they form when a large number of buyers or sellers enter the market, creating a price imbalance. The imbalance between buyers and sellers can be seen through fair value gaps. These gaps happen when price moves quickly, leaving orders unfilled, and the market may come back to these areas later to regain the balance. We mark the candle before the gap as our order block zone because we believe decisions are made during that candle. We expect that if the price returns to this order block, it could react strongly as buyers or sellers step back in. So basically, order blocks are supply and demand zones, but the difference is that we focus on areas where larger institutional orders are placed. Now, how do we mark the order blocks? We take the entire candle before the fair value gap and mark it as the order block. The color of the candle doesn't matter. For example, in a bullish gap, it makes no difference whether the candle is green, red, or even a doji without a strong body. All of them can be considered valid demand order blocks. Here's an important point. Sometimes a wick grabs liquidity before the imbalance happens. In that case, we also include the wick as part of the order block zone. This marks the real beginning of the imbalance, and our stop loss should always be placed below this wick for protection. Order blocks can be small or very large. When the zone is small, we should use a wider stop loss below it, Because even though order blocks are strong supply and demand areas, the price doesn't always reverse exactly from this box. We need to give it some room to breathe. On the other hand, when the order block is large, you can place your entry around the middle of the zone for a better price, or switch to lower time frames to look for confirmation and rejection signals. Number 5, top-down analysis. So what is top-down analysis? Top-down analysis means starting chart analysis with higher time frames, like weekly and daily, and then moving down to smaller details, like 4-hour, 1-hour, and 15-minute, to get a more accurate analysis. Now, why is top-down analysis so important? Top-down analysis is important because it helps you understand the market conditions better before you take any trade. When you start from higher time frames, you can clearly see the overall trend, strong levels of market structure. Then, when you move down to lower time frames, you can find cleaner entries and avoid trades that go against the bigger picture. In short, it keeps you on the right side of the market, reduces bad trades, and gives you more confidence in your decisions. This trading technique starts from the higher time frames, including the weekly and daily charts. The main chart analysis is done on the 4-hour and 1-hour charts. For extra confirmation, you can zoom into the 15-minute and 5-minute charts, but this part is optional. Now let me show you how to apply it step by step on the price chart. Step 1. Start with the weekly time frame. On this higher time frame, the only thing we need to focus on is identifying and marking key market structure levels. That's all we use the weekly chart for. We don't apply any other concepts here because they aren't necessary. Our main trading time frame is the 1-hour chart and lower. The reason we mark these levels is that when price taps into them, we expect a strong reaction, so we need to see them clearly when working on the lower time frames. But what are market structure levels? Market structure levels are important price zones on a chart where the market has previously shown a strong reaction. Every reaction can be identified as a market structure level, but here are 5 key criteria that make a level strong. Here we have the euro-dollar on the weekly chart. We don't want to overload the chart with lines, so only draw the market structure levels that are near the current price. When drawing these levels, keep in mind that you should place them at prices where you can capture the greatest number of touches. Whether you draw from the candle bodies or the wicks doesn't matter. For example here, if I draw the level like this, I can only get 2 touches. But if I adjust it like this, I get all of the price reactions. Also, treat the levels as zones, not precise single lines. With that in mind, here we have a key level at the top that has acted as strong resistance multiple times, so we mark it. In the middle, this key area has rejected price several times and has acted as both support and resistance, so we mark that as well. Don't worry about being perfectly precise here, because we'll refine these levels later when we move down to the lower time frames. Finally, we draw the tip of the long lower shadow as another key weekly level from the bottom. This is all we need from the weekly time frame, just marking the key market structure levels, so we don't trade blindly when analyzing the lower time frames. Now, let's move on to the daily chart. On the daily time frame, we first adjust the weekly levels from the daily perspective and candlesticks. Next, we draw the daily key levels of market structure in a different color. The reason for this is that we want to easily distinguish between weekly and daily levels when we zoom into the lower time frames, since the higher the time frame, the more important the level becomes. On the daily time frame, above the current price, this level has acted as both support and resistance recently, and the move away from it was strong, so we draw it in. At the bottom, this level is clearly a turning point on the lower time frames, so the price will probably react to it, and we mark it as well. This is everything we need from the daily perspective. We are not applying additional concepts yet, because we still have a long way to go before we reach the 1-hour chart. Now let's move on to the 4-hour chart. Now the 4-hour chart is where we start applying the key smart money concepts: market direction, imbalance, supply and demand zones, and liquidity levels. On the 4-hour chart, we can see a clear uptrend. We can mark the breakouts and also the swing points like this. However, the price has tapped into a higher time frame key level, which has the power to slow down or even reverse the trend. Additionally, just below the current price, there is a strong demand zone that coincides with a key weekly level. When price taps into this zone, we expect a strong reaction that can push the price higher. To trade this 4-hour demand zone, we need to zoom into the 15-minute chart and look for confirmations when the price enters this area. But for now, let's move to the 1-hour chart because it's the main time frame we trade. Here on the 1-hour chart, we do not have a clear trend. The market has formed a change of character in the 1-hour structure by breaking below this level, which signals that a possible reversal may be coming. But we also know the 4-hour structure is still bullish, and we have a strong demand zone below the price. So right now, the best thing to do is wait and see which side takes control. If the price breaks below the 4-hour zone, supply takes control over demand. In this case, both the 1-hour and 4-hour structures turn bearish, and we can confidently look for short trades. But if the price rejects the 4-hour demand zone and breaks above the daily structure, then both the 1-hour and 4-hour charts become bullish, and we can look for long trades. So, let's play the price forward and see what happens. Now we can see that after multiple attempts, the price finally broke below the demand zone. Now supply is in control, and both the 4-hour and 1-hour structures are bearish, so we can look for a short setup. Let's mark the breakouts and the supply zones. Here, we can also mark these equal highs, which act as a liquidity level. This creates a great trading opportunity. If the price pulls back into this supply zone, it will give us an entry. Once again, we get a breakout and a new supply zone forms. We can enter short trades until the price reaches the next important level ahead. So guys, that's it for today's break.